Hello, I'm Bernard Hickey from interest.co.nz and welcome to another in our series of double shot interviews where we bring someone in, give them a cup of coffee and have a chat about something interesting. And this is our weekly chat, our never a dull moment chat with Dan Bell from HiFX. Welcome to our Flash News studio, Dan.
Thank you, Bernard.
Today we are all on tenterhooks waiting for the Bernanke speech tonight at, well, early tomorrow morning at 2 o'clock. What are the market focused on with that speech? What are they watching for?
Yeah, it has certainly been a week of waiting and watching for this the speech from Ben Bernanke. The big thing, I think, is if you go back to the speech at Jackson Hole last year, that's when he announced QE2. So, with the recent run of soft economic data that we've had from around the world and the volatility, investors are looking at this weekend speech as another opportunity for Ben Bernanke and the Federal Reserve to come out with an additional policy measure to stem the recent volatility and give the US economy another kickstart.
It's fascinating, though, that different markets have different expectations here. It seems the stock market think, yay, we're going to get some money printing, but the others are not so sure.
Yeah, absolutely. So if you ask, fund managers or equity analysts, I think they're a little bit more optimistic, probably a bit more sort of wishful thinking more than anything. Because if he does come out with some sort of comment regarding QE3, naturally it's going to be positive for stocks and positive for their businesses. However, in fixed income land and foreign exchange land, I think we've all sort of come to the realisation that the speech this weekend isn't going to provide any real sort of panacea. The likelihood of him announcing QE3 is probably quite low. I think if anything, he may mention an extension of the existing bond purchasing program, but probably going to disappoint a lot of people who are expecting some type of QE3 announcement. Because
the first two rounds of QE, quantitative easing, money printing to buy government bonds, haven't really worked, and now with the potential for a third round, he's got an inflation problem to deal with.
Well, he does, and if you look at most of the measures of inflation in the US and around the world, inflation has been ticking up. You go back to this time last year, the economic data that we're experiencing at the moment is actually worse than what it was last year. So the last 12 months and QE2 for that matter haven't actually delivered any real sustainable benefits to the US economy or to the global economy in fact. So it's going to be interesting nonetheless.
Now, looking back across the Atlantic, we've all been focused on America and Bernanke, but there's still ructions going on in Europe. What's the story with those European money markets and the Greek situation, which is back to haunt us again?
Absolutely, yeah. The Greek situation doesn't go away. Just over the last sort of 48 hours, the yield on their 2-year bond has pushed up to a high of around 44%.
Better than Bridgecore.
Pretty much. So what's happened there is that there's been some debate and tensions between the countries involved in the Greek bailout, and Finland have come out and have asked for some sort of collateralised special arrangement from Greece, i.e. you need to give us some security if we're going to participate in giving you some further funding.
So some of the other countries are saying, hey, they got a side deal, maybe I can have one too.
Exactly. So, I mean, the whole thing is going to potentially break down. So I suppose there's question marks about the political issues within the European Union and going forward, whether or not they can get their act together and provide some kind of cooperated stimulus package for Greece. It's going to actually be sustainable.
And I understand that in Germany there's been more disagreement and criticism by the Bundesbank and by various political leaders of what the ECB and Angela Merkel are doing.
Yeah, absolutely. So you've got the old sort of German central bankers who are looking at the whole situation, and they continue to be concerned about inflation. They don't like the idea of the European Union printing money like the US have been, and I think that they're just generally concerned about the fiscal sustainability of Greece and these other economies that are struggling. So just a lot of uncertainty still in Europe, and I think that continues to be the major risk at the moment.
We'll call it Euro mess from now on.
Pretty much.
And across the British across the English Channel, Britain is talking about another round of money printing.
Yeah, that's sort of been on the cards for a little while. It seems that the members of the Bank of England who were actually a little bit more concerned about inflation have really started to soften. They've been putting austerity measures in place, and so from a fiscal point of view, there's not a lot of stimulus. So they're looking towards monetary policy to try and pick up some of that lost momentum. So. Probably more likely to see more money printing in the UK.
Now, back closer to home, we've had a big speech this week from the Reserve Bank of Australia, our largest trading partner. What's the picture now after that speech?
Yeah, so Glenn Stevens was the RBA governor, was out this morning with a speech, and he, the first thing he basically said was that he is concerned about the global growth outlook, and rightly so. However, he still pointed towards inflationary pressures in the Australian economy, and I think looking at the market pricing for the Reserve Bank's official cash rate, it's currently set at 4.75%. The market pricing is for 50 basis points of rate cuts by December this year. So. And yet, they do have inflation tracking up above their target rates.
And across this side of the Tasman, in New Zealand, we're still on track for an interest rate increase come December.
Yep, pretty much. So the market is pricing in rate hikes, a rate hike in December. So September is off the cards at the moment, but the recent sort of run of economic data in New Zealand, we had retail sales numbers out yesterday, which were better than expected. Trade balance numbers out earlier this week, which were better than expected, and obviously the expectation that the Rugby World Cup is going to provide additional stimulus, and then the Christchurch rebuild. So most of the local economists and market participants do expect the Reserve Bank to start taking away that emergency rate cut that we got back in February, March this year.
So we can blame Richie and Dan for another rate hike.
Pretty much.
So we're going to have potentially a rate hike in New Zealand before the end of the year, but in Australia a rate cut. What does that do for the New Zealand Aussie cross? What sort of ranges are we in at the moment?
Yeah, so we're currently sitting around 79 cents against the Aussie dollar. We've been as low as around sort of 78, 78.50. So the range for the Kiwi Aussie support around 78.50. We've been as high as 81.20 over the last few weeks. And there has been a general sort of uptrend in the Kiwi Aussie exchange rate over the last few months after we bottomed out at that 20-year low around 72.50 following the Christchurch earthquake. So as the interest rate differentials start to get closer, you'd expect the Kiwi dollar to continue to trend higher against the Aussie dollar.
And the New Zealand dollar against the US dollar, it's been fairly stable this week, unlike previous weeks. What sort of range are we in there?
Yeah, we're sitting around 83 cents at the moment. We've been down as sort of low as 81.50 this week. So for now, support comes in around 81.50, resistance at 83.50. Depending on what happens this weekend, obviously with Jackson Hole, it does seem as if the Kiwi US looks like it wants to continue to sort of grind higher. Doesn't look like it's going to sort of run away on us, but I suppose the expectations that we are going to start raising rates is enough to give investors a little bit more appetite for our currency.
And for those New Zealand dollar pound cross people who are watching, all those rugby players back in Britain who are putting money back or whatever, what sort of ranges are we looking at there? Because we're potentially hiking interest rates, they're trying to print money. That's
right, yeah. So the Kiwi pound is sitting around 50.5. We've been as high as around sort of 0.51 and as low as sort of 49.5 over the last couple of weeks. Again, it does seem to me that the Kiwi pound has more chances of pushing higher. Obviously, the economic outlook for New Zealand continues to be a lot more positive than the UK, and naturally, if the UK are prepared to print more money, we're going to see further weakness in the pound there as well.
And the New Zealand Euro cross for all those Irish bartenders in Queenstown, what's happening there with that cross?
So that cross, so we came under some pressure against the euro last week and the week before with the volatility that we've had. So with the sort of the global growth outlook getting downgraded, currencies like the New Zealand dollar, the Aussie dollar, the commodity sort of risk-on currencies came under some selling pressure. But we've stabilised around 57.50 against the euro at the moment. We've been as low as around 56.20. and for now it looks like we are going to continue to trend higher against the euro. Again, looking at those rate expectations in the European region, we don't expect the ECB to raise rates certainly any time soon, and naturally if New Zealand continues to raise interest rates, it's going to make our currency more attractive.
Yes, I can imagine the riots in Southern Europe if there was an increase in the European interest rate.
Absolutely, yeah.
Fantastic there. Dan Bell from High FX, thanks for coming in, and another in our double shot interviews. I'm Bernard Hickey for interest.co.nz.